All right, let's really begin properly. If you told a reasonably sane person 50 years ago that one day a large group of intelligent adults would gather in conference halls to discuss an invisible asset invented by an anonymous person, secured by puzzles that intentionally waste electricity, traded 24 hours a day by people who check their phones more often than their pulse, and defended with a level of devotion usually reserved for religious doctrine, that person would not have predicted global financial revolution. He might have predicted a hobby. Instead, we have Bitcoin. Now, I want to make something clear at the outset. I am not here to sneer at it, and I am not here to sanctify it. I am here to think about it. And real thinking requires detachment. That's hard when fortunes are being made and lost at speeds normally associated with casinos and tropical storms. Bitcoin is interesting not merely because of its price. Plenty of things go up and down. What makes it fascinating is that it sits at the intersection of technology, economics, politics, sociology, and human psychology. It is not just an asset, it is an ideology, a protest, a technological experiment, and a speculative instrument, all wrapped into one volatile package. Whenever that many forces converge, clarity becomes scarce. So let's start with first principles. Whenever something captures enormous enthusiasm, I ask a simple, boring question. What problem is this solving? Not what story does it tell, not how much did early adopters make. What problem is it solving better than the alternatives? Bitcoin was born in 2009. That was not a coincidence. It followed the financial crisis when banks were collapsing, governments were bailing them out, and central banks were expanding their balance sheets with impressive enthusiasm. Trust in institutions was at a low point, and into that distrust stepped an idea: money without trust. That's a seductive phrase. Instead of trusting governments, trust mathematics. Instead of trusting bankers, trust cryptography. Instead of trusting institutions, trust a decentralized network of incentives. It sounds clean, elegant, even moral, and I will give credit where it is due. The invention was clever. The blockchain solved a real computer science problem. For decades, people struggled with the issue of digital scarcity. How do you prevent someone from copying a digital token endlessly? How do you stop double spending without a central authority? Bitcoin's answer was proof of work. Make it computationally expensive to validate transactions. Reward honest participants with newly minted coins. Align incentives so that honesty is more profitable than fraud. That is ingenious engineering. But here's the first uncomfortable truth. Engineering elegance does not automatically translate into durable economic value. There is a difference between solving a technical puzzle and creating a productive asset. A productive asset generates cash flows. It produces goods or services that people need. It earns returns based on utility. A farm produces crops. A factory produces goods. A software company produces services. A bond pays interest. Bitcoin produces nothing. It sits there. Now that doesn't disqualify it. Gold also largely sits there. But the distinction matters. If an asset does not generate cash flow, its value must come from something else, namely what someone else will pay for it in the future. And that brings us to scarcity. Bitcoin has a fixed supply, 21 million coins. That feature is central to its narrative. Unlike fiat currency, advocates say, it cannot be printed into oblivion. True. But scarcity alone is not sufficient to create value. I could issue 100 digital tokens tonight and promise never to create more. That promise does not make them worth anything. Scarcity plus demand creates value. So where does Bitcoin's demand come from? Initially, it came from technologists and libertarians fascinated by decentralization. Then it came from speculators attracted by rising prices. Later, it came from institutions seeking alternative assets. Each wave added layers of narrative. Narratives are powerful economic forces. They shape expectations, they drive behavior. But narratives can outpace fundamentals. Let's examine the common narratives calmly. First, Bitcoin is money. Money traditionally has three functions: medium of exchange, store of value, and unit of account. As a medium of exchange, Bitcoin works in a narrow sense. You can send it across borders without a bank. That is useful in certain contexts, especially where banking systems are unstable. But in everyday commerce, volatility is a problem. If the purchasing power of your currency can swing 15% in a week, pricing becomes awkward. Most businesses do not want that risk. As a unit of account, Bitcoin is rarely used. Companies keep books in dollars, euros, yen. Salaries are denominated in fiat currencies. As a store of value, the debate intensifies. Its fixed supply suggests protection against inflation, yet its price history suggests extreme volatility. A store of value that can decline 70% in a year tests the definition of store. Second narrative, Bitcoin is digital gold. Gold has several characteristics: scarcity, durability, divisibility, and thousands of years of cultural reinforcement. It is embedded in human history. Bitcoin mimics scarcity digitally. It is divisible into tiny fractions. It is durable as long as the network operates. But gold does not depend on electricity. Bitcoin does. Gold does not depend on a global internet infrastructure. Bitcoin does. That does not invalidate it. It simply changes the risk profile. Third narrative, Bitcoin is an inflation hedge. In theory, a fixed supply asset should protect against currency debasement. In practice, Bitcoin has often behaved like a high beta risk asset. When liquidity is abundant and interest rates are low, it tends to surge. When liquidity tightens, it often falls sharply. That suggests it trades more on investor appetite for risk than on grocery store prices. Now let's discuss volatility more honestly. Volatility is not an accident. It is the natural result of a limited supply asset with highly elastic demand. When enthusiasm surges, price must adjust dramatically because supply cannot expand. When fear appears, the same mechanism works in reverse. This makes Bitcoin psychologically intoxicating. Rapid gains create euphoria. Sharp declines create despair. Both emotions attract attention, and attention is oxygen in modern markets. Social media amplifies this dynamic. Price movements become viral content. Memes replace analysis. Conviction hardens into identity. When an asset becomes an identity, rational debate becomes difficult. If you question the asset, you are seen as questioning the tribe, and tribes do not respond well to skepticism. Now let's consider decentralization, because this is a genuine innovation. Bitcoin operates without a central authority. No single entity controls issuance or transaction validation. That reduces certain risks, such as arbitrary debasement. But decentralization introduces other trade-offs. Governance becomes slow and contentious. Protocol upgrades require consensus. If you lose access to your private keys, there is no customer service desk. Freedom and responsibility are inseparable. Many people like the idea of sovereignty more than the reality of managing it. Then there is the matter of energy consumption. Proof-of-work mining consumes significant electricity. Supporters argue this cost secures the network. Critics argue it is wasteful. Both perspectives have merit. Security in any system requires resources. The global banking system also consumes energy, office buildings, data centers, armored vehicles. The question is comparative efficiency. Is Bitcoin's security cost justified by its societal utility? That answer depends on your assessment of its long-term role. Now let's introduce an often overlooked truth. Technological success does not guarantee investment success. The automobile transformed civilization. Many early car manufacturers disappeared. The internet changed everything. Many dot-com investors were wiped out. Being correct about a technological trend is not the same as being correct about an asset's valuation. Price matters. If expectations become extreme, even a successful technology can disappoint investors. Bitcoin's valuation at various points has implied enormous future adoption. Perhaps that adoption will occur, perhaps it will not. But certainty is unwarranted. Another element rarely discussed calmly is regulation. Some enthusiasts assume governments are irrelevant to decentralized systems. That is optimistic. Governments control taxation, banking interfaces, legal frameworks, and monetary policy. They may not shut down a global protocol, but they can shape its accessibility and cost structure. History suggests that sovereign states rarely relinquish monetary influence without resistance. It is wise to factor that into your analysis. Now, after all this, let me say something that irritates both sides. Bitcoin could endure as a significant asset class and still not replace traditional currencies. It could integrate into the financial system without overthrowing it. Revolutions are less common than adaptations. The financial world has a habit of absorbing innovations rather than being destroyed by them. So what is the truth about Bitcoin? The truth is that it is a scarce digital asset secured by decentralized computation, whose value is largely driven by collective belief and adoption expectations. The truth is that it has demonstrated remarkable resilience over more than a decade. The truth is that it has experienced repeated boom and bust cycles, driven by liquidity and psychology. The truth is that it produces no intrinsic cash flow, making valuation inherently speculative. The truth is that it represents both genuine innovation and classic human herd behavior. The truth is that it exposes deep distrust in institutions. The truth is that many participants underestimate volatility. And the final truth is this: markets are unforgiving to those who confuse narrative strength with economic inevitability. If you own Bitcoin, understand what you own. You own a non-yielding, scarce digital asset whose future value depends on sustained demand and belief. If you avoid Bitcoin, understand that dismissing it entirely may ignore genuine technological innovation. The rational position is not fanaticism. It is probabilistic thinking. Assign probabilities. Consider downside, avoid leverage, recognize uncertainty. The world rarely conforms to extreme predictions. Bitcoin may become a durable store of value. It may remain a volatile trading instrument. It may coexist with central bank digital currencies. It may evolve in ways none of us predict. But whatever happens, the greatest lesson it offers is not about cryptography. It is about human behavior. Greed, fear, hope, distrust, ambition. These forces drive markets more reliably than algorithms. And if you can understand those forces both in others and in yourself, you will be better equipped not just to analyze Bitcoin, but to navigate any financial innovation that comes along next. Because there will always be a next, and it will feel just as revolutionary. Thank you.